So yeah, I mean, just a little background on kind of myself. I think there's probably will give you some good context as to why we've done some of the things we've done as BTCS. So, I started my career as an engineer, lived through the internet bubble bursting, was in compound semiconductors, then sat out the, post-internet bubble burst. I went back to business school, got my MBA, finished that in 2005 and did investment banking. So I was at a couple boutique investment banks doing SPACs, reverse mergers, pipe financing, so a bunch of these Chinese reverse mergers. We did some of those. I wasn't at Goldman Sachs. It was a company called Broadband. So we did, for example, like American Apparel is one of the deals we did. Jamba Juice was another deal. I don't know if you've heard of these companies or US companies, both, listed. It was a very interesting perspective. So I learned over almost 10 years, got, really in a niche industry in terms of micro cap, public companies. And I got into crypto in 2013, and it didn't used to be called BTCS. The original name of the company was Bitcoin Shop. So in 2013, Michael Handerhan, who's currently still the CEO, has been with the company since founding it in the summer of 2013. He created an e-commerce website, bitcoinshop.us. It was a little LLC in the and they had an e-commerce site where you could buy stuff with crypto. It was really not a very good business model, to be honest. But at the time, you couldn't buy anything with crypto. And literally all they did was throw up a website where they pulled the top 100,000 products from Amazon, relisted it, and then you could buy that with Bitcoin. And they used BitPay as the payment processor. So not a great business model, but as a side business, and this is 2013, right? Bitcoin's like, sub $200, right? Yeah. Crazy to think about now. And so they got approached by an investor group to go public via reverse merger onto the bulletin board. That's when I got involved. They'd reached out to me for some advice. I told them how to respond to the term sheet. Long story short, I helped them raise about $2 million and took the company public in February 2014. So we were the first public company in the world, I think in the world, in the crypto space. Yeah. Which is, it seems like forever now, right? Like, in crypto years, it's like I'm a dinosaur. And so the business model, wasn't very good, right? We were an e-commerce site. We kind of tried a couple different avenues to make that viable. We started investing in some other companies, and we started mining Bitcoin. So we were the first US public company to mine Bitcoin. In the end of 2014, we were mining Bitcoin. We had a facility in North Carolina. We built it up to 3 megawatts. And we actually had a merger teed up with Spinduli's, who's one of the largest, second largest ASIC manufacturers, right? Second to Bitmain. We were going to vertically integrate, and Bitcoin crashed from I think 1,200 down to 230 or something ridiculous, and we were unable to raise capital, right? Like the markets just dried up, and the SEC was not letting us through with respect to a registration statement, right? So we kind of ended up in a weird position where we defaulted on a convertible loan we did, set the stock it basically wiped out all the equity value for everyone, right? The convertible notes, it went toxic. It's one of these things called a death spiral, right? Basically, it was a bridge loan to an underwritten offer, didn't get it done, a death spiral, everyone lost their money, including myself, right? Like if you owned equity then, you lost everything. A couple reverse splits later, we didn't give up on the company. We stayed in business, and we kind of had another opportunity to reboot the company. We've done a couple pivots within the crypto space. So that brings us, and I'm giving you the history because I think it's relevant, especially with some of the other companies you cover. So that brings us to about, I think that was around 2016, I think. And we kind of dug ourselves out of the hole. We're able to get some financing. We kind of looked at ourselves. We're like, well, that was really stupid, right? Why did we should have just bought Bitcoin and Ethereum. That was our conclusion. Bitcoin had increased to between $2,000 and $3,000 from the 200-ish. Ethereum And when we were mining Bitcoin, we were mining a little bit of Ethereum. This is before being proof of stake. And I think it cost us $3 to mine in ETH, right? And it was trading at $7. So I mean, these numbers are, you got to put things back in that time frame. And we looked at it, we're idiots. We should have just bought Bitcoin and Ethereum, and we would have been maybe a $500 million company, right? It's a little bit more challenging than that because investors weren't giving us money just to go buy crypto and do nothing, right? Like there's a little bit of a chicken and egg problem that no one would have given us the money with that business model because they'd be like, well, why don't I just do it myself, right? But we basically decided to do that, and we came out with the business plan of let's buy crypto, not just Bitcoin and Ethereum are the big ones, but let's get others, right? And this is around, I think it was Polychain Capital had come out. We had come up with this plan, pitched it to investors, put out a PowerPoint presentation, which was on file with the SEC. Investors were kind of like, nah, we don't like that, right? We're not going to fund you. And then we got really lucky. One of the guys from Coinbase started Polychain Capital and raised $20 million from like Andreessen Horowitz and some others. And then I sent that to the investors. I'm like, hey, this is the business plan we just put out. And now you've got these really, the guys that you would look at and be like, oh, this is the smart money doing it. Like, okay, back us. And so they didn't give us as much as we needed, but they did start funding us. And so we bought Bitcoin, Ethereum. We bought a couple other tokens. But then when we went through the SEC process, they're like, well, are those securities or not? And they wanted like a whole analysis. So we just sold them all. Like, forget it. Bitcoin and Ethereum, we'll keep it simple. And so while we were doing that, and this is kind of what I look at as like a digital asset treasury strategy, like what MicroStrategy did. So we were well ahead of them on that. The next thing we were looking at doing some other, we were also looking at acquisitions. And I'm giving you a little bit of this background because of the other companies you cover. So in 2017, we'd actually teed up a merger, and this is not publicly available, though it's not material, it's all ancient history. We'd actually teed up a merger with BitBuy, which subsequently is what WonderFi purchased, right? So if you cover WonderFi, I'm an investor, full disclosure, I'm an investor in WonderFi through my investment in BitBuy from like 6 years ago. Know that team, know that company very well, right? Because we almost merged with them, right? Back when it was like 2 guys or 3 guys and we were like the same size. The other thing we did is for the big miners, the investors in BTCS were the same investors that basically put together both Marathon and RIOT, right? So they learned about mining through us and then went and helped pivot those 2 NASDAQ companies, because we were still on the bulletin board, into mining. And if you actually look at Marathon, they were supposed to merge with another company I was involved with called, and hopefully this history is interesting to you. They were supposed to merge with a company,
very interesting.
Global BitVentures. So Global BitVentures had raised about $7 million. We were mining Ethereum and we were starting to mine Bitcoin, and we were going to merge with a Marathon. I was going to take over as CEO. At the same time, I was supposed to exit BTCS, because BTCS was going to merge with BitBuy. And I wasn't going to be able to stay on in that merger in the capacity as CEO. So I was like, great, I get my equity here and I'm going to be CEO of Mara here, right? And you can actually look, apart from the BitBuy deal, which never got disclosed, we had a term sheet, but there was no, it didn't cross the threshold of materiality, meaning it was a non-binding term sheet. We didn't have to disclose it. Based on the facts condulies didn't come through. We didn't want to have another deal that didn't, announcement of a deal that didn't come to fruition, right? The Marathon one you can go look up. If you go to the SEC filings for Marathon and type my name, you're going to find a proxy merger agreement from 2017. So we handed them a business model on a silver platter. And then they took it and canceled the merger and went and built their own mining business. Not upset, because Global BitVentures got 10% of, maybe it was 11% of Marathon as a break fee. For them walking away from that deal, they gave up about, I think it was like 10.2 or 3% of the company to us, which turned out to, worked out quite well, depending on, we took that Marathon stock, distributed to our Global BitVentures shareholders, and depending on how they sold it, some people could have done phenomenally well, or, I mean, now it's at $5-6, but it went up to 60. So I know some guys are like, I don't care, the deal didn't get done. Like the break fee and what they got, they were ecstatic. I don't know if that's helpful from a background perspective. That kind of fast forwards to where we are with BTCS. So the Marathon deal with the other company I was involved in fell through. I wasn't going to leave the BTCS shareholders high and dry without the BitBuy thing happening, right? Like I was only doing this one if I left our current shareholders in a much better situation. Both deals fell apart for multiple reasons, market conditions, et cetera. And so we kind of continued on as BTCS with our digital asset treasury strategy, which was working really well, right? If that was in 2017. Fast forward, we were raising money, continually buying crypto, Ethereum in the $200-300 range, Bitcoin in the $2,000-3,000 range, until about the end of 2020. And at the end of 2020, our crypto value had increased to about 7 million. That's pretty good, right? Like from where we were buying. And we kind of looked at like, okay, what do we do as a business in the crypto space that is appropriate for the public markets, that can get a good return, that's not really risky. Like I really don't like Bitcoin mining. It looks great on the balance sheet, but at the end of the day, you're buying equipment that will be worthless in 1 to 2 years. You're better off just to buy Bitcoin, unless your rate of return far exceeds, if you're getting 15% return on your money, there's so much risk for that business model, right? Just buy
it's buying Bitcoin with leverage. Yeah, some companies a lot of leverage, so it's good when it's going up, but it's very bad when it's going down. So yeah,
awful. Very expensive, very competitive. Most of Bitcoin miners, I don't know if you cover any of them. It makes a lot, like Marathon, for example. They're in Texas. They're doing long-term power purchase agreements. And they can make more money being a grid balancing company, right? A brownouts company, hey, we need electricity for the grid. You can't call Google and be like, shut down your servers. People need to search, right? You can't call Netflix. Like if there's a data center that's got servers running for Netflix and people are streaming videos, you cannot shut that down. They're gonna, they've got tier 3 data centers with all sorts of crazy backup. The Bitcoin miners love it because they're like, wait, I can shut my stuff down in 10 seconds. Call me up and pay me a lot of money and I'll give you your electricity back. So they're in these long-term power purchase agreements, and they're more of a grid balancer, right? Than they are a crypto play, right? They're an energy arbitrage opportunity. That's kind of how I look at them, with the mechanism that allows for that and the sustainability coming from Bitcoin mining. Other Bitcoin miners are doing other things. I've seen one like using the excess heat to heat a greenhouse or some, who knows. I don't think there's a market for Bitcoin miners that don't have a secondary revenue source based on the other things they do. It's just too competitive. That's my view, right? I mean, others can.
No, it's true. Like Hut 8, I thought it was a great company because they put all the Bitcoins on the balance sheet. But yeah, they diluted shareholders so much. The stock price went down and the Bitcoin on balance sheet went up, so that it's not how things should go, because they diluted that much. That's why I stay away from Bitcoin miners as much as possible. There are a few good ones. I'm looking at Bit Digital now, for example. It's maybe one of the few smaller miners with a little bit more security, but that's also one of the reasons why I stay away from the Bitcoin miners as much as possible. Yeah.
We kind of looked at it at the end of 2020, said, all right, we've got all this crypto, what can we do? And that's when we got into staking, right? And we looked and said, hey, you know what? I really like Ethereum more than Bitcoin. I like, don't get me wrong, I like Bitcoin, but it doesn't do anything. Bitcoin doesn't do anything. It is a store of value. It's a digital store of value that has a value proposition similar to gold. We could debate, hey, can you, and it's a slow on transaction. We could talk about Lightning networks and how that can speed it up. Okay, great. We could talk about, root stock as a way to build smart contracts on top of Bitcoin, or stacks, which is now more in the, the news recently. But none of them have really shown that Bitcoin is a good blockchain as a platform to build on top of, right? Like, why would you mess with Bitcoin when you can use Ethereum? And then the debate goes, well, why are you using Ethereum when you could be using Solana or, all these other chains that are third generation blockchains, right? Ethereum's kind of working to keep up with these upgrades, right? We got Shanghai coming, we got some other things. Bitcoin is like, I love it, but I view its use case as very simple. as a public company, it makes no sense to have Bitcoin on your balance sheet, right? You mark it down to the lowest price it's ever been ever, right? You don't get to mark it up, and it doesn't generate any revenue.
Yeah, it's true. Yeah.
Like, okay, like as a public company, like, well, how am I growing, right? Like, you know, you might as well just have GBTC, right? And do that. So anyway, we decided we were going to get into staking. We did that at the end of 20. What was it? We decided we were going to do it at the end of 2020. We didn't pull the trigger until 2021, primarily because, you know, as a public company, there's a lot of other, it's not as simple as like what the private companies do. We looked at this and said, okay, what is the accounting for this? We had some questions. It was unclear. And we had an audit to get done. So had we moved into that space in 2020 and started staking, I think you could stake Ethereum beginning of like December 13th, maybe of 2020, around there. Let's call it late Q4, right? I forget it's a little while ago. And the thought was, well, what if we get this wrong? Then we have to restate our financials and we're in a really bad spot. Let's just wait to the new year and let's go ask the SEC. So that's exactly what we did. We went to the Office of Chief Accountants at the SEC. We had a very detailed memo of the two different ways you could account for it, which there was not clarity, multiple phone calls. I mean, this is like, we're getting into the minutia of accounting, which is actually really important because if you follow Mara and Riot, they both just restated like within the last couple of days. I don't know if you saw those.
I follow Banxa and they're trading halt since October last year, also because of their results. They are in discussion to how to present the results, and the trading hold for I think almost half a year now. So
because the banks,
I think it's a great company,
right?
Yes, tell me.
Banks they're traded in Canada and then also in the OTC markets, right?
Yeah, and Canada is trading hold since October or so, and I think in the US since a couple of weeks also.
Yeah.
Yep. And you see them pronouncing contracts or partnerships, and you think, oh, that's great. Like they partnered with MetaMask. It's a great way to grow for Banxa, but you don't see it in the stock price because it's halted, and it's frustrating. But I get it. It's got to be good accounting, and it seems to be very difficult these days to get the accounting standards right.
It's very complex. I mean, one of the things we've done is we've gone and asked the SEC, and I've really dug into the weeds on this stuff, like what Marathon and Riot recently did. And this is, I know, a little bit of a tangent before I want to go, but I think if you cover some of these, it's interesting. So crypto doesn't fall in a regular bucket. It's not a currency. It's not a commodity. It's an indefinite life intangible asset, right? And so there's very specific accounting of that. You have to carry it at the lower of cost, whatever you paid for it, and impair it. So you bring the carrying value down if there is an observable input that it's decreased in value, right? So in 2017, we had to restate our financials because we had been carrying crypto at fair market value, right? This is before anyone was doing this. This is 6 years ago, right? And so we restated, and one of the things that we did is said, okay, we have to impair it. And our advisor said, well, you just impair it to the closing price. Look, well, crypto doesn't close, but just use Yahoo Finance's 4 o'clock, whatever, it's good enough. And I looked at it and I said, no, I don't think that's good enough because I have to pick the lowest price. How can I, in my argument, like then what I told the advisor, I said, look, crypto trades all day long. The lowest price it trades in a day, including a flash crash, how can I ignore that and turn a blind eye when there's an observable input? He said, it doesn't matter. It's immaterial. Just take the close. You're marking it to the close. I said, no. I'm going to do the low. Like, well, whatever. It doesn't, I don't think it matters, right? This is 6 years ago. Fast forward to as recently as this week, Marathon, Riot, all did that, picked in some point in the day and are restating their financials.
Okay.
And I went with the, no, I can't ignore it. And it's the lowest. So literally our auditor sent us this like a day ago. So We carry our crypto at the lowest that it trades on a given day. Like if it flash crashes, bam, we're taking it. I don't know. No one reads our financials anyway. What do I care? Except the SEC, right? The SEC reads our financials, right? And maybe institutions and research analysts, but most retail investors don't. Anyway, so I know I jumped off on a tangent there. I just thought that would be a little helpful. And so kind of going back to where I left off at 2021, we got into staking. So we started staking Ethereum. I really like the staking model because now our capital is tied up in a potentially appreciating asset, right? It's definitely not going to break. It's not like a computer, right? It's not going to, like a Bitcoin miner is 100% going to break at some point and be useless. Right? Like crypto is an indefinite life asset, right? Like, so, I mean, it could theoretically go, right? Like we owned 100 grand of Terra, right? Like, well, that's zero. But like our Ethereum, so we basically started staking Ethereum and built out our nodes. Ethereum is really interesting because it's obviously number 2 blockchain, and that was the majority of our revenue in 2021. It was I think we did 1.2 million for 2021. A very high margin, right? Because we don't have to, we don't have high electricity costs. We don't have a huge data center. We use Amazon Web Services. So we don't even have to, it's Amazon Web Services is amazing, right? I mean, I know a lot of people are like, well, why everything's getting condensed into Amazon or Google or Azure. And it's like, I don't care, right? Like it's, if Amazon, Google, and Azure all go down, the internet's done, right? The internet is coming down, right? If Amazon went out, if all their data centers went down, the internet would crash until they brought them back, right? You would overload Google and Azure, and if any of those three, there'd be major disruptions. But they're all decentralized within their own entities, right? They have, within Amazon, you can pick, do I want a data center in Ireland? Do I want one in the UK? Do I want one in the, you can pick, choose, set up. It's unlimited custom, how you can customize basically unlimited within these providers, and you can control your costs that way. Anyway, so that's what we do. Like all of our staking operations are done using AWS. We may expand, diversify into GCP and Azure, but for the most part, we have no intention of building a data center, buying our own hardware, running our hardware, hiring staff to.
Have you thought about Filecoin as a data storage? Because that's, I think, a very interesting play on cryptocurrency.
I really like Filecoin. I know the guy that started Storage. I don't know if you know, if you follow Storage. They were built on, I think, MadeSafe initially, and then pivoted. I forget what blockchain they're built on now. But yeah, I like Filecoin. I think the problem is for us as a business, like I don't want to be, storage is a much different game. And it hasn't really picked up. So it's one that I like the concept of what you can do with it. I don't think it's the right fit for us as a company from a revenue and return potential, right? Risk reward just isn't there. I think there's better ways for us to make money, but I think it's a really, it's one of those things that I think could fundamentally change how we store information on the web, right? It doesn't mean again, for us,
okay. Just my thought.
Yeah, no, I've looked at there's decentralized computing platforms and protocols. I've invested in a company that did that personally, but it's like, I don't think this is right for the company, right? Risk reward, too much risk. And we also don't invest typically in companies, right? We'll do one-off things occasionally. But anyway, so we got into staking Ethereum. And Ethereum is really, it's the biggest one, but it's the lowest return. And we looked at this and said, okay, this is the first one. The next thing we did is we started spinning up validator nodes for other blockchains, right? And that was kind of through, if you look at our press releases throughout 2021, we're constantly adding new blockchains. And the philosophy was we're going to expand into other next generation proof of stake blockchains that some will fail, hopefully not the ones we're picking, but where we think, the things that we think could be the foundation of, Web 3.0 and blockchain technology. So now we own over like 10 plus different tokens that are running validator nodes on those. Apart from Ethereum, one of the things we've been doing is all the tokens we secure are not proof of stake, they're delegated proof of stake, which is, are you familiar with the nuanced difference?
No, not
Okay,
particular.
so there's like Bitcoin, Litecoin, Dogecoin, these are all proof of work blockchains, meaning you've got mining to maintain the networks. Ethereum's proof of stake, which means you have to stake your crypto to run you can run a validator node, but with Ethereum, you have to run a validator node, you have to stake 32 ETH. There's no fractional amount, and you can't delegate to someone else. So
I'm using Lido myself, so that's in the pool, and that stays. So I don't have 32 ETH.
Exactly. You use Lido, or you could use Rocket Pool. Here's the problem with that. We looked at this and said, how do we stake ETH? I think Lido and Rocket Pool have basically created securities, right? I think what they've, because you really don't own Ethereum if you staked it with them. You have a token that represents staked ETH. To me, if I put my SEC hat on, I'm like, that looks like a security, 100%. Now it's DeFi, okay, we can throw some fancy words in, but it looks like a duck, quacks like a duck. The SEC is going to think that's a security, right? Which is why we never went down of like trying to build a platform like that, because I know how that's going to end, right? It ends exactly how it ends for Kraken, right? And it's, same with Coinbase. Coinbase is doing the same thing. I actually am really irritated with the message Brian Armstrong's putting out on Twitter. He's like, well, the SEC is not, they're going after crypto and it's wrong. I'm like, no, they're actually not. This isn't gray. This is black and white. You're breaking the law, right? Like they are blatantly, this is so blatant. They talk about staking and, how it's decentralized and how it's supposed to work, but that's not what they do, right? They take your money. So you no longer have, your keys, your crypto. No, Coinbase takes your money, just like Kraken did. They take your money. If they go bankrupt, they could lose it, just like FTX, just like Celsius, etc. They take your money, they pool it with other people's, right? And then they invest it in staking and tell you what they're going to pay you. But what they pay you may not be what the network pays them, and they take 25%. So I don't know how much you follow securities law, but like there's a simple test. If there's an investment of money into a common enterprise with the expectation of profits by the efforts of others, that's a security. With what Kraken did, it was a blatant security. With Coinbase doing, it is a blatant security. Like I get like beside myself when I hear Brian Armstrong out there on Twitter and his rhetoric. It's like, dude, just put on your big boy pants and realize you're breaking the law. The SEC is 100% right on this. Now, where it gets questionable is like, well, what do we do, right? So with Ethereum, we stake for our own account. That was the majority of our revenue in 2021. We haven't figured out, well, I know how to do it, but not how to do it without creating a security. Like I couldn't do what Rocket Pool does, what Lido does, because I think that creates a security, right? You've securitized Ethereum staking. With the other chains we do, Cosmos and Kava and Cardano, Tezos, all these others, they're delegated proof of stake. And this is really interesting. What it means is we spin up a validator node, right? So we've got our own money in there and we're staking. And then if you want to delegate to our node, you can do that. But we don't take your crypto, right? So you'd have to go get your own MetaMask wallet or whatever wallet for the particular blockchain. You take your crypto, you take it off exchange, you hold it, which is probably a good thing anyway, right? And then you can delegate it to our node. And so if you went, I'll use Cosmos because that's the biggest one. So if you own some Cosmos and you delegate it to our node, we don't take your crypto. So from our perspective, that's not a security. There's no investment of money. We don't take it. You've locked it into a network-based smart contract. I can't go buy a Ferrari with your crypto, even if I wanted, right? I don't have it. And then the rewards are paid by the network directly to you. And so my fee I set in the when we spin up our node, we set what our fee is, and everyone can see that publicly broadcast on the Explorer. So right now our fees are 0 because we're trying to get customers on board or delegators on board, which means
the same thing you're doing with StakeSeeker.
That's what StakeSeeker is doing, right? So we basically in 2021 we launched all these nodes over time. So we got the back end set up of what do we need to do to run these nodes 24/7 with our own money, right? The next was, okay, let's figure out. Let's open the delegated proof of stake nodes to customers. And what StakeSeeker really does is you don't need to use StakeSeeker or platform to delegate to our nodes. You can use StakeSeeker without delegating to our nodes. So you can do one or the other, or you can do them both at the same time. It doesn't really matter, right? StakeSeeker is a standalone platform. Even if you don't delegate to our nodes, you can connect your exchanges, Coinbase, Kraken. It'll pull the data, read-only data via APIs, and just organize it for you so you can see your returns across multiple exchanges. You can get the same thing from the blockchain for staking, and it's just data. That's it. So no, you can't buy or sell crypto. You can't do anything. You can just look at your data, right?
So if I'm staking Ethereum with Coinbase, you can pull the data from Coinbase to StakeSeeker, and I can see it, and I can see how much how much rewards I get, but it's still, the Ether is still at Coinbase and not
exactly. And we're building out the different analytics of what you can see, adding exchanges like, hey, I think we've got Coinbase, Kraken, Binance, but I don't know if it's US or which. It's relevant. So we got a bunch. All of the exchanges have, not all, but 99% of the exchanges have some sort of API where you can pull that data out, right? So we're just pulling that data. We're also looking at blockchain-based data. So you can pull the blockchain data in if you had a wallet that was off exchange, and just organizing that data. We don't charge for that. It's free. Anyone can use it. It's still in beta. So, if you're in there and you want to test it out, there's some bugs. If you find a bug, let us know. We'll work on it. But, one of the thoughts is let's just open this thing in beta and have the community and users, who don't charge for it anyway, point out, help us make it better, right? We kind of figured it's easier to open it up, and in a beta, people are going to be not bash us too much and give us helpful feedback. We've actually found a lot of bugs. People are like, well, that doesn't work. Like, great, thank you, right? Like, appreciate it. Like, I would have to pay someone to figure out, find that thing that you just found for me. You can stake to our nodes without signing up to StakeSeeker. We kind of try to push you through StakeSeeker because it gives you directions, more information. We'll know a little bit more about you as a customer, but you can just delegate to one of our nodes without it, right? Just like you could use StakeSeeker without staking to one of our nodes. It's kind of a value add, right? Like a free value add. So with the validator nodes we run, you delegate your crypto, right? We don't take your keys. The network will pay you directly. When we were running the nodes in 2021 and 2022, we took 100% of the fee. So there was no incentive for anyone to delegate to our nodes, because why would you delegate your crypto to a node that doesn't pay you, right? It's stupid. Now we set our nodes to 0, meaning we get 0% of the fee. We're not going to keep it at 0 forever. There are very few people at 0.
Yeah, of course.
Right. Yeah. This is hey, let's grow the balance on the nodes, and then over time we'll set it to a market rate. I think Coinbase charges 20%. I don't know what we're going to charge. The average is 10. Something competitive, right? We'll do some analysis. Right now,
if you want to add to the node, is that also through StakeSeeker, or is that through the BTCS platform?
Well, there is no BTCS platform, so you can. I mean, I can actually show you if that's helpful, like an example. Let me share my screen. I'll show you Cosmos because that's got a great. Let me hear. Sure, you probably have to. Okay. So here is, if I go to validators, right? You can see this is Cosmos. Stakefish is number 1. This is the number of tokens delegated to Stakefish, their voting power, whether they vote on proposals, their uptime, and their commission, right? They charge 4%. They're the number 1. Dokia, they're 15%. Like, I don't know why anyone would pay 15. when they could pay 4, but whatever. I mean, it is what it is. And so, you got Binance, Everstake, Kraken. You can notice Kraken has the way we used to have it set up is 100% of the rewards go to them. Now they still have a lot staked to them. My gut is that's their own money or their customer funds, and they're doing it in a custodial way, right? If that makes sense. Like they're taking your money for your exchange account. They hold your crypto. They're staking it on your behalf. And so they take 100% of the reward and they pay you whatever they say they're going to pay you versed on the terms of service, right? Versus if you delegate to these nodes via your wallet where you hold the crypto, you will pay these guys 9%, you'll get whatever the rest of the reward is. So if you go down to where we are, right, and you got a couple of these guys at 1%, where, we just opened this, I think 6 or 7 weeks ago. Where we got to go down a bit. All right, so we are, 129, right? So, oh wow, we've grown since yesterday. Okay, that's nice. And we've got the growth. Like our node, we used to be at about 150 or 60, and the last 6 weeks we're just kind of moving up. So you can see here, 100% uptime, 0% commission. So there are very few people with 0% commission. If just to give you an idea, and all the blockchains are very similar to this, right? So you can see when you go to 0% commission, there's, for Cosmos, what, like 1, 2, 3, 4, 7 people that charge 0%. This one's no fee till 2025. So they've kind of said, okay, it's free for now. Let's grow the balance and we'll add something. We haven't put one. We're going to make it not free. So right now we're offering 0% commission. We also enabled something called auto stake, which out of these guys, I think only 1 or 2 also offer. I forget which ones. And what that means is usually if you stake to one of these nodes, you earn your rewards, but it doesn't compound. You've got to you've got to restake the reward portion manually. Okay. So what we do now is you have to set it up, right? You're basically via a smart contract delegating authority to us to restake your crypto on your behalf. And so we'll do that. If you set that up, it's not automatic. We'll restake your crypto twice a day for you. And if you add the analytics on top of that, we're the only company right now doing 0% fee, auto stake, and a data analytics. I don't know if you got a chance to look at our corporate presentation.
I don't know if it's the last one, but I think a few weeks ago or. Okay, so
as long as you looked at it, so it hasn't changed, but that's basically the business model, right? Let's get people to stake to our nodes. At some point, we're going to turn on the fees, and if I look at it as, okay, let's say we have, just kind of taking a step back, if we had $100 million if we have $10 million of our own capital, right? We have about twice that, but just for simple math, and we make 10% on our money, we are making $1 million a year, right? That's our revenue. We have about 20 million. Some of the rewards are higher. Crypto prices move, so it's kind of a moving target. That's the baseline. That's an 80% plus margin business. If we raise more capital, we can stake it and grow revenue. That's the Bitcoin mining model, right? Mm-hmm. You got to keep plowing capital into it. So I still think it's much better than Bitcoin mining, but it's still capital intensive. You're not wasting your money on computer equipment. You add the staking as a service, StakeSeeker. StakeSeeker, frankly, the analytics is a way to drive people to stake to our nodes. It's an incentive component. It's free. But StakeSeeker, if you think about it, if we had 100 million of delegated assets to all of these different blockchains, and the average, I'm using averages here, it's easy, was a 10% reward, and we charged a 10% fee, that's 1% of 100 million, right? So we would make an additional $1 million a year in revenue with really zero additional cost of goods sold or cost with that, because it doesn't, you could put $1 billion on a validator node and it doesn't cost you anymore, right? There's no more computer processing power. So that's the business model, which is scalable, right? That's a scalable model. Unlike, it's more like having a Bitcoin mining pool, right? You set up the pool, people come in, and now you're clipping a fiat for everyone, but you don't have the high overhead. So we really like that model. We're doing it on, 10 chains. Ethereum, you can't do it on because it would create a security, but that's effectively our business model. Right now we're kind of looking at a little kind of, hopefully that makes sense, right? We're the only public company doing this model solely, right? Coinbase kind of does it, but Coinbase has VC investments. I mean, they're, different animal. Up in Canada, there's a couple similar, but not close. Tokens.com, I don't know if you follow them or ever looked at them. They used to stake, but they didn't run validator nodes. They would, actually, that reminds me, I got to call them and see if they'd staked our nodes. Then they started buying land in the metaverse or something, and I don't know.
Yeah.
I mean, I was like,
That's when I thought, okay, I got to stay out of here for the moment. Yeah. I followed them, but then that's when the moment I thought, okay, no.
I know the CEO, and I call him, what
Going to do that. So yeah.
I don't know. Like, makes no sense. Anyway, he's a good guy, but like, to me, I'm like, that's all risk, no reward. What if you buy land in the metaverse and like the ghetto or the dumps, right? You don't know, and no one's even in the metaverse, right? If you look at the statistics of like how many people are in the metaverse versus valuations of the companies doing stuff in this, it's like, this is way off in the future. This is beyond the horizon type stuff, at least in my opinion. Anyway, the only other company similar, there was Tokens, there's Ether Capital, but they more or less just hold Ethereum. Now they've started to stake Ethereum. I know there was one Bitcoin miner that was going to pivot in, because I spoke to the CEO and he was like, fishing for information on how to do it and what to do. And then there is one other, Neptune Digital, I think. They're up in Canada as well, does some Ethereum staking.
Yeah, I followed them too, yeah.
Yeah, I haven't looked at them in a little bit, but they're similar, but they're not. We're doing delegated. I mean, we're kind of, I think, a little bit deeper in that we're running the nodes on multiple chains, offering the analytics platform. So I would put us more in line with a couple private companies like Figment, Block Demon. We're like much smaller than these big guys that are dominating the non-custodial staking. I think it's a really interesting time for our business model with, Kraken getting fined, all of the, a lot of the exchanges or lending platforms failing, right? Like Celsius, BlockFi. If you rewind like a year or so ago, people always said to me, well, why would I stake? I can make 2 or 3% more on my money by lending via BlockFi. And my thought was, well, one, you don't have you don't hold your crypto, so you've got exchange risk. I lived through Mt. Gox, and we had money there and pulled it before because we saw red flags. I'm like, so you could lose your money if the exchange goes. Two, for them to pay you 15%, they need to be making 20 or 30%. What are they doing to get that return? You have no idea. Huge counterparty risk that you don't understand. And I think that came to bite people. And I think there's actually a big focus now on staking and non-custodial staking, which is our business model. So the time is actually really interesting for us. So that's kind of the summary on the on the kind of the business plan, like what we're doing to grow revenue, drive revenue. I'll touch on a couple other things, and then love to hear your questions. So
yeah, but I got to run, to be honest.
Okay.
Would happy to chat another time. But I got it till 5, so it's 3 more minutes. But I think BTC is a very interesting company. JP Morgan, I read an article says Ethereum staking was the start for a $40 billion market, staking market. So if you can grab a piece of that could be awesome.
we have a piece.
Yeah, but then I love the way you talked about it, and because you are taking the regulatory approach, I always think that those companies, especially for crypto stocks, when they go that way, that's a big advantage, because the other, if it's not regulated in a few years, it's all going to disappear. I think so. It's very, very nice. Been a nice chat about the BTCS, because I I thought it was a great company. You're doing great, and now I think even better because you explained it very well. And
Yeah.
we'll have to chat another time.